This PowerPoint video presentation attempts to explain the following points. How Banco Filipino's attempt to book 12.1 billion pesos in losses as assets is actually prevalent throughout the banking industry. How the BSP and the Monetary Board allowed the deferment and amortization of unrecognized losses arising from SPV transactions, acquisitions of failed and or failing banks, and large credit losses. Why the BSP action allows some banks to operate as Ponzi schemes, with little or no capital cushion, to back up the inevitable loan losses that may come from an economic downturn. In the congressional hearings on Banco Filipino's closure, last May 17, 2011, Congressman Georgie B. Ampaw, who is a certified public accountant, expressed surprise at how Banco Filipino attempted to book 12.1 billion pesos in losses as assets. The BSP characterized Banco Filipino's capitalized losses as Ampaw or puffed-up assets. He said that such Ampaw assets are matched by Ampaw capital. He also said that the capitalization of losses does not conform to generally accepted accounting principles. He explained that there is no jurisdiction that would consider Ampaw assets to be real assets. The value of such assets is zero. However, in the same congressional hearing, Congressman Luis R. Villafuerte says that Banco Filipino was really imitating what BSP has allowed many other banks to do, which is to defer the booking of realized losses and gradually write off realized losses over a period of 10 to 20 years. Congressman Villafuerte is in a position to know, because his wife, Nelly Falvis Villafuerte, sits in the Monetary Board. Congressman Villafuerte is correct. The BSP and the Monetary Board has allowed many other banks to defer the booking of realized losses and gradually write off the realized losses over 10 years to as long as 20 years. The BSP has allowed this for losses arising from the sale of non-performing loans to special purpose vehicles or SPV, the acquisition by a bank of another weaker bank with substantial non-performing assets, large credit and impairment losses on financial assets of banks that are undergoing a BSP-approved rehabilitation plan. On December 23, 2002, the Philippine Congress passed Republic Act 9182, otherwise known as the Special Purpose Vehicle Act of 2002. The act provided a framework for the creation and regulation of special purpose vehicles that acquire and invest in the non-performing assets of financial institutions. It granted fiscal and tax incentives and exemption privileges for transactions involving the transfer of non-performing assets to an SPV and from an SPV to a third party. The law was designed to address the burgeoning non-performing asset problems plaguing the Philippine banking sector by encouraging private sector investment in non-performing assets, improving the liquidity of the financial system as a whole. However, SPV transactions had a very significant problem. Both SPV investors and banks faced a classist pricing conundrum. The SPV investors wanted to buy non-performing assets from the banks at a price low enough for the SPV investors to make a decent profit that will compensate them for the risks they undertook. Banks wanted to sell their non-performing assets at a price high enough to minimize losses that will impact their equity capital. Often, the two parties to the transaction could not agree on price. So, the BSP rode to the rescue of the banks. On September 26, 2003, the BSP issued a memorandum regarding the Monetary Board Resolutions No. 917, dated June 26, 2003, and No. 1199, dated August 21, 2003, approving certain accounting guidelines on the sale of non-performing assets to special purpose vehicles. The guidelines provided temporary regulatory relief, in addition to tax relief under the SPV law, particularly in the timing of the recognition of losses, so that banks may be encouraged to maximize the sale of their non-performing assets, even at substantial discounts. The banks would be able to avail of this regulatory relief, provided that the banks shall fully disclose the impact of this relief in all relevant financial reports, in the interest of upholding full transparency and sustaining market discipline. The BSP allowed banks to book the losses they realize on the sale of their non-performing assets to an SPV as deferred charges that may be written down over 7 years. On February 5, 2004, the amortization period for deferred charges was extended from 7 years to 10 years, according to the following schedule. The BSP also allowed banks to book losses as deferred charges as part of a BSP-approved rehabilitation plan for a bank that acquired a weaker bank with substantial non-performing assets, and a bank that incurred substantial credit losses. As the BSP Deputy Governor said, the booking of losses as deferred charges does not conform to generally accepted accounting principles. The booking of deferred charges does not conform to the provisions of Philippine Financial Reporting Standards or Philippine Accounting Standards in the preparation of audited financial statements. Banks will still be required to comply with Philippine Financial Reporting Standards and Philippine Accounting Standards for the purpose of preparing audited financial statements. Banks that do not comply with these accounting standards will show a qualified auditor's opinion that states that the bank's booking of deferred charges does not comply with the provisions of generally accepted accounting principles, Philippine Financial Reporting Standards, and Philippine Accounting Standards. The audited financial statements will also disclose the impact such compliance would have on the bank's financial statements had the losses been recognized. In 2005, the BSP governor warned that availing of the regulatory incentives involves a trade-off, in the sense that audited financial statements may warrant a qualified opinion from external auditors. Banks with strong balance sheets may very well opt not to defer the booking of losses to avoid a qualified auditor's opinion. As of 2009 and 2010, the audited financial statements of at least 10 Philippine banks show a qualified auditor's opinion. These banks range from small to large in asset size. They have a total of 70.1 billion pesos in deferred charges. These unrecognized losses will result in a reduction of total bank capital funds, ranging from as low as 11.48% to as high as 721.43%. For some banks, a recognition of these losses may completely wipe out the bank's shareholder capital. The 10 banks with a qualified auditor's opinion range in asset size from small, 11.6 billion pesos in assets, such as Asia Trust Development Bank, to large, 515.6 billion pesos in assets, such as Land Bank of the Philippines. These 10 banks have a combined asset base of 1,612.5 billion pesos. The 10 banks with a qualified auditor's opinion range in capital funds size from small, 1.4 billion pesos in capital funds, such as Export and Industry Bank, to large, 33.3 billion pesos in capital funds, such as Philippine National Bank. These 10 banks have a combined capital funds base of 156.0 billion pesos. The deferred charges discussed here refer to the unbooked losses, quantified and disclosed by the bank's external auditor. Recognition of these deferred charges as actual losses will reduce bank assets and capital by a corresponding amount. The 10 banks with a qualified auditor's opinion have deferred charges that range in size from small, 1.1 billion pesos in deferred charges, such as Philippine Veterans Bank, to large, 28.0 billion pesos in deferred charges, such as United Coconut Planters Bank. The 10 banks with a qualified auditor's opinion have a combined deferred charges base of 70.1 billion pesos. The amortization period for deferred charges ranged from minimum of 10 years, such as Asia Trust Development Bank, Bank of Commerce, Export and Industry Bank, Land Bank of the Philippines, Philippine Bank of Communications, Philippine National Bank, Philippine Veterans Bank, Planters Development Bank, Rizal Commercial Banking Corporation, and United Coconut Planters Bank. The middle range for the write-off period is 12 years to 15 years, such as Planters Development Bank, Export and Industry Bank. The maximum range is 20 years, such as Philippine Veterans Bank. Had the unrecognized losses, or deferred charges, been booked or recognized, the capital funds of these banks would be greatly reduced. The impact on capital funds would range from low 11.5% reduction in capital funds, such as for Land Bank of the Philippines, to high 721.4% reduction in capital funds, such as for Export and Industry Bank. Some banks will have at least a 50% reduction in capital funds, such as for Bank of Commerce. Quite a few will experience a complete wipeout of capital funds, such as Asia Trust Development Bank, 100%, Philippine Bank of Communications, 163.9%, United Coconut Planters Bank, 190.5%, and Export and Industry Bank, 721.4%. The unrecognized losses, or deferred charges, represent a significant chunk of the total capital funds of the universal and commercial banking system as of December 2010. The total deferred charges amount to 70.1 billion pesos out of the 711.5 billion pesos in total capital funds of the universal and commercial banking system. In other words, around 10% of the total capital funds of the largest Philippine banks has to be written down to zero.